Hey guys, welcome to the Wyckoff Trading course part 2. This is the first session of the summer cycle. As always, everything that we discuss in these classes is for educational purposes only, so stop your recording and read the disclaimer in full. Let's talk about the class. We have two groups of people. First of all, the ones that signed up for the class already, and you guys already some of you kind of tuned in into our way to educate. This means that you know that after each session, you're going to have some kind of homework. Now, WTC1 definitely, makes another step from WTC1 course where your weekly assignments are going to be each week. And you're going to have quite a lot of homework between the bias game, anatomy of the trade, and then any additional homework, optional homework that I'm going to give you, whether it's just a read on of an article or maybe some additional chart work. The cost is less just because we have 12 sessions instead of 15. Now, it doesn't really matter, especially for this class, WTC2, where we practice and we do a lot of drills and you do a lot of homework. So it doesn't really matter whether we have 15 sessions or 12. Practice is practice, so we're just practicing 3 weeks less, and therefore the price is less. For those of you who are alumni, and there are quite a few of you in this particular course, right? So we are taking that, this class multiple times. Why? Because we want to create that habituation in the deliberate practice, and that requires some time. So very, very favorable alumni rate if you're repeating this class for the second, third, or whatever number of times you're repeating this. And the payment plan, which is a very affordable option at $283 per month for 3 payments. So consider that. You could register on our website, wyckoffanalytics.com, under the Wyckoff Trading course part 2. Or you can contact Nancy at wyckoff@gmail.com. These are all our 12 sessions. We're on session number 1. Our class time is between 3 to 5:30. Sometimes we'll finish later, sometimes we'll finish earlier. I tend to finish late in WTC1. I tend to probably finish sometimes a little bit earlier with WTC2. It just depends on how much of the material we have. For those of you who have attended WTC1, you already know my requirements for the homework. I want just one file, whether this is a PowerPoint, PDF, or Word doc. I do not want a zip file. Please don't send this. We'll talk more about the anatomy of the trade homework, which will be sent separately. So I would be expecting 2 homework files from you in one email. That would be the best. And obviously, I still want your first name and the letter of your last name, class, in this case, WTC2, and then the number for the homework. And please send this to me at wyckoff@gmail.com. A very common question, and that is this session going to be posted on the YouTube channel? Absolutely. As we process the video, we will post it either tonight or tomorrow morning, and you'll have a chance to watch in full if you can go through the whole session. All right, yeah, Eric is saying, yeah, 3rd time in a row, and I'll talk more about why some of the students are taking this particular course multiple times in a row. I already mentioned this, but we'll develop this more in the next session when we will talk about the way how we practice in this class, and we'll definitely talk about logging in a certain number of hours, certain number of exercises, and then on the top of that, we'll talk about how exactly we're going to do that practice. And we definitely want to do this in a very, very qualitative way. All right, so here's our curriculum. So we are going to definitely apply a lot of the knowledge that we've have taken from WTC Part 1. It's a foundational knowledge for us. And now we need to convert it into a skill. So that's what this class is all about. Taking the fundamental knowledge and then going through the exercises multiple times throughout the semester, doing all of the homeworks, especially with the bias game and anatomy of the trade, and just build the skill of recognition and execution on the top of the knowledge. And obviously, this is all about going through a lot of drills and exercises. We will talk a lot about bias and timing, but specifically bias. And with the bias, we're going to discuss the bias in multiple ways. So we have created in WTC1 the way how to make observations and deductions, right? WTC1, observations, and then deductions. In WTC2, we're gonna start talking about a specific sequence of analysis, right? So sequence of, let's say, a trading range analysis. How do we do that, right? So for the last number of semesters, I think like maybe the last 6 to 8 semesters, we've been building this material. And this is what we come up with. I'm going to teach you how to do the sequential bias analysis. And we're going to do this in 2 ways, in the horizontal way, and then also vertical. I'll explain this later, so let it be like a cliffhanger for you a little bit. Number 2, we're going to talk about the flashcard bias analysis. So just another way to analyze the chart. And then we'll talk about the quantifiable bias analysis. So that's all on the way how we actually analyze using the Wyckoff methodology. So I'm going to give you a step-by-step. Look at this first, look at this second. During the, when you look at that second thing, these are the things that you need to look at. Specifically what happens with the price, with the volume, with the whole structure, with the character, and so on and so forth. So we'll go through all of that, and this is going to be extremely important for us. Then once we understand the bias, different type of scenarios, building, trade management itself, we're going to spend a lot on trade management and execution and scenario building based on the anatomy of the trades that you guys are going to submit. So I'm going to be coaching you each session, except for this first one, as to how to go through the execution of your trades that you have done in the past. And I'll teach you exactly the way of how you should be post-analyzing your past trades. We'll talk a little bit about the risk management. This is not like a concentration on risk for us, but we'll definitely, through your trades, talk about this. Filtering trading candidates, we have some selection exercises on that. And then again, we're gonna go into in-depth on the Wyckoff material itself. And here, even though we're talking about the phase analysis, variation on the volume signatures, trend analysis, which is a very, very important thing for us to consider. But the main knowledge that I'm going to give you as in-depth knowledge is going to be the extension of our discussion from WTC1 course on significant bar analysis. And we have developed this quite a lot from, let's say, significant bar and tests and characteristics of those to actual stop loss movement, and also from here we are talking about codification of this technique. And then on the top of that, we're going to talk about the swing analysis. And under the swing analysis, again, the swing characteristics, and codification of that. So this class, especially in the last 10 semesters, and I've been teaching this class and WTC1 classes, for the last, 12 years about? Yeah, around 12 years. So you can imagine, how many students went through these classes. But this is probably the most developed version of the WTC2 class that we've been creating for years and years and years. So it's like a good wine, and just like really becomes better with time. And this is where we are. Also, we'll discuss a lot of modern TA tools and their usage in the context of Wyckoff knowledge and so on and so forth. But the whole concentration here is most definitely on the practice. Okay, WTC1, for those of you who are guests in the open door session today, please check it out. This is the prerequisite for WTC2. So it's extremely important for you to get this first before you sign up for WTC2. I would absolutely check out the free session that happened yesterday. If you missed it, you could catch this on YouTube on our Wyckoff Trading Method YouTube channel and sign up for WTC1 on wyckoffanalytics.com. Again, favorable price just because of the 12 sessions summer semester. It's being taught by Alessio Rutigliano, and Alessio is just an amazing Wyckoff teacher. Check out his work from yesterday on YouTube and sign up. And specifically, like, what kind of foundational knowledge Alessio will go through in this semester? Market structural analysis for the first 4 sessions. So there's going to be a lot of talk about how does the different types of environments are being created in the market. Who's responsible for that? So a lot on the behavioral market analysis, introduction to the composite operator heuristic, price cycle, and then within the price cycle, all of the Wyckoff characteristics of the trading ranges, starting from the phase analysis to Wyckoff events, and a lot of other purely Wyckoff things to consider and to expect. Then the second part of it is all about price and volume. So supply and demand analysis, effort versus result, is one of the most important things for us to consider. So this is definitely going to be a big concentration. Bar by bar analysis, I mentioned observations and deductions, introduction to those, swing by swing analysis as well, and historical analog. So all of that is going to be introduced there. Relative and comparative analysis, not a lot to add to some of the knowledge that you already have, but a lot of like Wyckoff nuances or my personal twists on that, and Alessio will explain this in all of those sessions. Trade management, and then Q&A. So I would definitely check out at least the free session, and then I would definitely consider signing up, especially if you, after this session, would want to sign up for the practicum. Okay, session number 1 today. After the introductions, we're going to go into our regular market update. So each class after the intros starts with the market update. Why do I do this? It's extremely important for me to show you how I use the methodology, how I apply this in my analysis and also execution as well. It kind of connects the knowledge to the application. And then throughout the whole semester, you will be able to see how my thoughts about the market or where the market is change. And somewhere there will be stretches where I'm going to be extremely good, and I'm going to be calling the market pretty closely to what the market is doing. And then some spots it's going to be difficult, and I'm going to make some mistakes, and I want you to see that. And I want you to see how I overcome those mistakes as I analyze through them, and then how I overcome them as I trade that. So very important. I know that a lot of you guys have the same moments in your trading and in your analysis as I do. And just because we're all the same, we're all humans. So even the emotional way of how to go about those is extremely important to observe for our students. So market updates has been always very popular. I usually discuss the same set of charts. You will see this today, and this is going to be each week. So as you could see, there are quite a few things that we do in these classes, right? So we go through the market update, we go through the bias game homework, we go through the anatomy of the trade, which I will explain next in the next session. This is more proprietary. And then we also do some exercises during the session itself and new material. So quite intensive 2.5 hours. For those of you who are guests, you kind of have to get used to this. For those of you who are students, obviously you guys already know. We're going to go through exercise number 1 on observations and deductions today, and then we will review. Oh, I apologize. This is incorrect number for the bias games. Forgot to update the numbers here. I believe, and you guys help me out from those alumni from last semester. What is the number? 187, right? Or 188, 187? Okay. Yeah, I think we did 185, 186, Eric. I think Michael is right, 187. Yeah. So we'll do this. So this means 188 is for the next week. And okay, so what else do we have for today? Yeah, and I believe that's it. And then in the next week, I'm gonna give you the homework, which is gonna be the article on the quantitative and qualitative practices. This is gonna be your homework on the top of the bias game. So a couple of articles to read over the week. And then we'll talk about the anatomy of the trade, and we'll start reviewing that as well. All right, with that, here is your first homework. So this is already uploaded to our website. So your class is gonna have a special landing page. You have the access to that already. By the way, I want you to remind you that you need to go through the exam, right? So I'm gonna look at your results as with WTC1. At the end of the semester, you also will take the same exam. So we're just doing this to kind of show you your progression throughout the semester. So we'll have to look at that at some point. So what is your homework assignment? 2 articles. One, the first one is actually not an article, but a chapter from the Outlines by Malcolm Gladwell. We'll talk about 10,000 hours that we need to spend on something. And then the second one is the article. It's called The Mundanity of Excellence. This is the piece on the Olympic trials and the way how specific, how 2 different types of swimmers prepare for the Olympic trials in which way. So we'll have to figure this out. Then in the next class, we're going to combine these 2 articles and we'll talk about our trading path. And how we have to go about this, what kind of tasks we need to have for the number of years in order for us to gain the deep knowledge, to develop the deep skill, to correct our maybe mindset in terms of the mental executions and so on and so forth. So we'll talk about this. And this is a really good exercise to see where you are at and where you want to go and what's in between. So this is just kind of like the articles is a catalyst for that discussion. The more meat is going to be given to you next week, and I'll tell you exactly what to do. So we also have bias game number 188. Anatomy of the trade will be discussed as the homework in the next class. And what else? Yeah, that's it. So don't forget, guys, for those of you who signed up or who will be signing up, please read these 2 articles on our website on the landing page for your class. All right, let's do the market update. Not a lot has changed since last week, when we last discussed the market in this particular class. And as a community, we discuss the market each day or almost each day during the week. So on Mondays, we usually would have WTC1 or tape reading lab. Then on Tuesday, WTC2. On Wednesday, WMD market, Wyckoff market discussion with Bruce and myself. And then on Thursday, you can catch up, some of the market updates and specifically crypto updates from the Wyckoff crypto discussion with Alessio. And as we look at the current market structure, and we're looking here at the daily chart of the S&P, right away, I would divide this trading range, and let me just show you so that you would see a little bit better perspective here of the downtrend and then subsequent trading range. I would divide this trading range into two parts, or maybe like the whole structure, I would divide into three parts, right? So let's just do that. Part number one is your downtrend. You could see this very clearly from a conventional definition of the downtrend based on technical analysis. Lower highs, lower lows. Supply increase, and the price follows to the downside with the breakdowns. Breakdown number one, breakdown number two, breakdown number three. Then we go into part number two. Part number two is what I could call this multiple ways, but I'm going to start with first definition of where it all starts, part number two, with the selling climax. We have a stop in action, which is our selling climax. Then we go into a trading range, which I believe is an accumulation at this point. But in this specific part of a larger trading range, right? So our trading range is all of this. In this first part of the trading range, we're seeing high volatility. So it's kind of counterintuitive to think about the trading range with high volatility, which is an accumulation trading range, because usually we would be expecting that it's the bearish character would have a lot of volatility. But we're definitely seeing that as the price stops at the selling climax, produces an automatic rally, secondary test. And by the way, there is a lot of question, is this a true change of behavior right here? Yes, it is true change of behavior, because it's a true change of behavior to this last leg, to the downside. If you're looking for a true change of behavior for the bearish downtrend, which is this, then you're going to be taken into the context this whole rally, which is much larger rally than we have seen in the downtrend environment. So we definitely see that change of behavior rally, whereas a localized change of behavior rally is much smaller. And that defines our phase A. The intention behind phase A is always a stop in action. So we stop. What do we stop? We stop a downtrend. And then after the series of tests on the decline in the supply, we are having a change of behavior rally that increases in duration and extension and has a bullish character behind all of the up and down bars. So with that, we are saying that, first of all, trading range is confirmed. Secondly, there is some kind of bullish nature to this rally. Why? Because of how it looks, how far it extends. The only problem with this rally is that it doesn't really have a lot of demand behind it. It's more that the demand came on the way down rather than on the way up. And from this, you conclude that there's going to be some kind of reaction that could retest the levels of the support. And we are definitely seeing that. As volatility increases to the downside, we are not only reaching the support, we actually go into this sprint type event, which has, again, volume on the way down, and then finally we're starting to see the volume on the way up. So if the second part of this whole structure is a stop in action, change of behavior into a trading range. Let's just do this, change of behavior that leads to the trading range. And then we have a high volatility still. Then the third part of this trading range, part number 3, is still an accumulation with lower or decreasing volatility, which is a bullish behavior. And also, what's really, really important, between part number 2 and part number 3, we are seeing the change in structure. So for instance, what are we seeing? What kind of changes in structure do we see? We're seeing localized higher highs and higher lows for the first time. And that's basically it. This is how we're viewing this structure. So I think that the biggest problem that students have right now, and there's been a lot of frustration, and believe me, I'm on the receiving end of this each day, either through the email, either through the social media, either through the question in the classroom. And each day there is somebody kind of keeps asking me, yeah, are we truly in the bullish market? Yes, we are. The problem with that doubt is that we are in a bullish market, in a bullish environment, and I would say we are probably there from late September, October. So this is where I would say bullish environment starts for us, just because volatility goes down and the structure changes. Okay. But the problem with this bullish environment is that the indices do not show an uptrend. And by an uptrend, I mean like a major uptrend, and not localized in the trading range uptrend, where we still have higher highs, higher lows, definition of an uptrend. So don't get me wrong. But I'm talking about like an uptrend that actually travels like an uptrend after the trading range. We don't have the breakout, and we don't have the extending higher highs, higher lows beyond the trading range. And that's the confusion. So how could it be that we're in the bullish environment and yet there is no major uptrend? Very selective market. And there is still a lot of supply, a lot of selling that's going on. And by the selective market, I mean that when we look at what's outperforming right now, what started to outperform at certain periods especially in 2023, are the mega caps. And because of their weight in the indices, this is the bifurcation that we're seeing in the markets. Something is actually not going up, something is actually going up a lot, and with a lot of momentum, just because it's been sold so much, like the tech stocks, semis, software. It's been sold so much. There is so much like long-term value after the downtrend that they have had, that institutions are coming in and they are absorbing that supply. And that stops the downtrend, and that starts moving the price up with a lot of momentum. Yet other stocks may still be in some kind of trading ranges. You look at the banking stocks, banking crisis, right? So they were even in the downtrend, and now they are range bound. And that's the bifurcation of the market. Something is bullish going up, and it influences the bullish character of the market. Yet something else is providing selling, and that is being reflected in the reluctance of the price in the indices, let's say specifically in the S&P, to actually come out of the structure. But imagine this as we discuss supply and demand. So supply is pushing us from the top, right? And we are looking for what? We're looking for the supply to go lower. And demand is pushing up from the bottom. And what we are expecting is something like this, where demand is actually going lower first, but yet the price is holding. That would be suggestive of an intermediate step of extreme importance, and we'll have to discuss this. And then the next stage is demand is starting to go up. Okay, so let's discuss this a little bit. First of all, we see how two forces from above and from the below interacting with each other, right? So there is a lot of exchange of shares. We see in a lot of volume, but that also condenses the structure. And because of that, because of that contraction between two forces, we're seeing the creation of an apex or a triangle. Now, usually apex is a continuation pattern. Now, in this case, I think that we're going to have a true accumulation rate here, which is not going to be, long-lived. I think that we're probably going to go to the all-time high somewhere here, and this could happen in a very short period of time. I'll show you the analog for that. We've discussed this many times. And then we probably gonna still have a repeatable bear market, especially going into the end of the year or beginning of 2024. And that all is going to depend on a lot of variables, right? Like how's the Fed's going to behave, what kind of inflation numbers we're going to have, is the consumer, revenues are going to deteriorate and they're going to go into more saving mode. Are they going to be fired? Unemployment is going to go up, and so on and so forth. Those type of things I will mention during my market update if I, feel that it's necessary. But for now, I'm explaining general concepts in our first class. We also have to think about what is happening within the trading range, right? So let's go from the tree to the branches now, and then we'll talk about the leaves. So on the branch level, we're seeing quite a lot of reactions within the trading range, and we're seeing how all of these reactions are deteriorating in terms of the force of selling behind those. We're seeing that in the diminished downward spread. That's number one. We're seeing that in the diminished distance of the downward swings or reactions. We're seeing how we are starting to create, after October low, which was the lowest low, we're starting to create higher lows and higher highs. Those are local higher lows and higher highs, but those are extremely important. We're also seeing how overall level of supply is going down. And if we were to identify the three major places of where supply is present, we're seeing that majority of that is on the way down and the stop in action. And those are identification of the phase positions for us as well. And there was like this big question I've been thinking a lot like a month ago as the structure started to develop. Where is our phase C? Could this area right here be our phase C? But that seems to be like a much lower probability because we still need the testing in phase B. So if this is phase A for us, and this is an upthrust, and this is a sprint type event, this feels like the two tests that we need in phase B. So if phase C is somewhere to the right, and we're still in the structure, so therefore any type of reaction could be phase C, then we are probably identifying phase C based on the volume signature rather than on the price structure itself. And usually during the phase C, we are going to have some catalysts, and banking crisis was one of the best catalysts for us, as a possible identification of phase C. So then the biggest question is, well, why phase C actually does not go, let's say, below into the spring, or maybe a last point of support does not come to the level of the support? Well, in apexes, this is what happens. your phase C last low is going to be somewhere in the middle of the apex formation. And this is exactly what we're seeing. It's in the middle on the axis line of this whole trading range. And the volume confirms that it's a second point of fear, right? So material from WTC1. And this kind of concludes the structure. So the only thing that we are waiting for is phase D, where we should have a sign of strength and then a backup. Now, a sign of strength and backup in the apex formation is quite different. We usually would see some kind of very small sign of strength and a backup, which is going to be shallow and low duration, with almost no reversal whatsoever of the upswing, and then continuation to the upside. And now that I'm looking at this, this is the correct interaction with the resistance, right? So we have, by the way, this black dotted resistance. Look at from one line to another. This is the extent of the overthrow above the resistance, right? It's the same as the extent of the underthrow below the support, same distance. So there is this beautiful symmetry that we're seeing here for the whole downtrending channel. Okay, so then we definitely see in how we first look how the change of behavior happens here, how the price transitions from a downtrending environment into the trading range and confirms a possibility of an uptrend. First, we are touching, like we've touched here, then we overcome on the intraday basis as an upthrust, come back into the downtrending channel, come to the mean this time, not to the support or to the lower support, to the extreme oversold condition, but to the mean. So in itself, this is an element of strength. And then what do? We overcome the resistance that now starts to act as the support. So first, we extend above the resistance and we have multiple progressive closes up. Again, an element of strength, presence of the buyers. 1, 2, 3, 4, 5 progressive closes up. And then the price still stays in this extreme overbought condition before going into the reaction. And then the reaction comes to the exact point of the support that we need. And demand is occurring here and supporting the whole idea that behind such catalysts as the banking crisis that should have extended the gains to the downside, yet did not happen. So still bullish, effort versus result. So with that, we are overcoming this line right here and we hold it. And we are definitely interacting with multiple lines right here, right? So there is an apex line, there is the red line, which created the boundary, resistance boundary for the trading range itself. We are above the 200 moving average, extended away from that. Also, a bullish sign right there. And instead of reacting which way, like this, right? When you come to the top, to the resistance, what kind of supply do you have on the way in? And we're just not seeing a lot of supply, right? So this is probably like minus 25% of less selling. This is a very favorable approach. We could say that there is most definitely less selling. And then instead of having some local volatility in this trading range, this is all muted. There is really not a lot that's going on right here. So this tells us less selling, more probability that we're going to overcome this. And what's the next target? We could stay here. We could still kind of like test, but then this is our next target. And then obviously just the extension itself, we could prognosticate here just the breakouts, something like this. This should take us to the all-time high. And I would be thinking something similar to something similar to, let me just show you this analog from my tweet here. Okay, so I'm comparing gold futures to the S&P 500 futures. So we've broken this and we are right here right now. So this is even better than this testing right here. I mean, we still probably could have some kind of reactions before the move up, before the final move up. And I would be expecting that some kind of fear of missing out is going to happen here. Just because still there is a lot of cash from hedge funds that is not being used. Actually, above the last number that I looked at is 56% for money managers in cash and for hedge funds. That's a big number. So imagine that the market will start moving up, they will have to catch up. And the only way how to catch up is to put more money into the market. There is also a lot of hedges still that I hear from the bears. And that those hedges need to be closed at some point. So we'll have to see. Okay, now let's continue with something else really quickly. Let's look at NASDAQ. So NASDAQ obviously was outperforming. Now it's slightly on a local basis underperforming. And there is really, you know, like for the failure here to happen, I would say like even this level right here would be fine if you go down to this level and you create some kind of like structure right here. But there are many other bullish type of scenarios where we're just going through the mean. You know, it means touches, closes above, coming above that mean, coming to the support of it, and that's exactly what we're doing. To a touch, a close. Could we overcome this, use it as a support, and then go up again? We'll have to see. But the more advanced structure for NASDAQ and tech stocks have been very favorable in this environment where there is a switch from value back to growth. Why? Because there is an anticipation that for multiple months now, and I'm going to show you the 10-year yield chart, the interest rate should go down. And that is very favorable for growth stocks because the cost of their borrowing is going down and they constantly need money for, you know, to put in the business for the development purposes. Okay, Russell, small caps, underperforming. In this area right here, there are days of outperformance, but what's encouraging here is that despite of the banking crisis taking Russell down so significantly, we're still creating a higher low relative to the lowest point in the trading range. That's number one. Secondly, we have a local spring trading range, and with multiple demand tails where that tells us the story of buying rather than selling. But having said this, the most important bars on this chart for Russell is still these two bars. Capitulation on the way down during the banking crisis. This is where a lot of supply has come. So what we want to see is kind of like this ability to creep up and then suddenly to have an acceleration where momentum is increasing and the upward spread is increasing, and it shows the extension above the resistance and intrusion into the capitulation bars. That would be the most important thing for us to see. If this were to happen instantly, we're confirming phase C in this whole structure. And then our expectation is that we're going to continue with the upward movement. The Dow is showing a lot of symmetry here for being in the downtrend, then changing that in the change of behavior during the change of behavior rally or a sign of strength rally, and then going into the backup trading range, which is downsloping, and it has its own signs of weaknesses. 1, 2, 3, 4, 5. Those are the bars that are breakdown bars and behind the lower highs, we're expecting some kind of lower low sprint type of event, and it happens. And again, look at the buying that comes behind the tails and behind the increase in the volume signature. And this is a local spring for the backup trading range, which becomes a sign of strength rally. And we're seeing a really good extension here. The test is all to the upside. So, I mean, here we are at the resistance. We could react here, or we could go slightly above that and still be, totally okay and totally bullish. And it's kind of interesting how in this market, all of the four indices, all of the four majors are having different type of structures. Okay, let's go to gold. And our analysis of gold have been extremely good. We have changed our downtrending definition to the uptrend on this particular bar. This was an analog bar to the bars that were showing the takeoff and the demand presence. And we finally have noticed after a potential change of behavior rally with the suggestion that we are in the trading range, that this last third bar was expanding the result on somewhat of the same volume signature, somewhat of the same equal effort. And this definitely was bullish. So this was the call for the bullish behavior. We said that we're going to have a very quick rally up into a sign of strength. And this was also identified as a viable opportunity, as a spring, a backup. And then after that, we said that we are in the bullish environment right here until this catalyst has happened. Some sale by the central bank of 3.5 tons of gold, and that's what it produces. Momentum decreases to the downside, and then suddenly this bar gives us a big clue that this is all over, and now we're going to have the rally. Because of the banking crisis, this becomes a flight to quality. Flight to safety, and there is a rearrangement of how demand is actually increasing. If before we see demand increase, then now demand is increasing a lot. And that gives us an understanding of two things. At this point, on the way up, what we were discussing are two possibilities for the trading range that could develop. And from our students, the whole idea was that, well, we just had a change of behavior, and this was the question. We just had a change of behavior. With that, this means that we're going to go into a trading range. And I said, actually, no. The aggressiveness of the background itself, number one, and then the aggressiveness of the localized rally suggested that instead of a trading range, we're going to have some kind of vertical absorption pattern. And vertical absorption pattern is usually buying on the way down, buying on the way up. That brings us to the point of the resistance. Then we go through the horizontal test and then continuation. Well, look at this horizontal test. Beautifully down. So like this was a really good call on the structure and on the character itself. And we even stronger, if we were to compare this area right here, how it starts, we are stronger than this area right here. These are the two analog areas. So with that, I believe that we're going to make an all-time high here. We're just not that far away. We've also commented on gold from the much larger perspective, right? So this whole structure where we've seen the original accumulation, hard to think about this, but you know, back right here and here, we were calling for gold to go to 4,000. This was the highest PNF count that I had, you know, for this whole structure. Nobody would believe me. I actually had a call here in 2019 that we're gonna get out of the apex formation and reach 1,500, and that was a very interesting bet. And we are in the major sign of strength, being followed by the major backup action trading range with phase C sprint right here. And this rally is much better than the previous rally. So therefore, extension above. And then the biggest question is going to be how much are we going to extend? You know, what would be the character and so on and so forth. Okay, so that's our gold. We are at 350. Usually we should be done by 4. It's taking me a little bit longer just to go through all of this, just because I'm doing this as if we're doing this for the first time. Bitcoin also was a great call once we started hitting this area right here. So we've identified the hidden presence of the demand, expansion of that demand behind the shortening of the thrust of the breakdowns in a downtrend. And we said, with this amount of the demand and with this diminishing downward result, this could be the stop in action, like for the whole downtrend. And we said after that, we need to have some kind of testing. And then after that, we need to see the emergence of the demand. And that has confirmed to us that this whole structure right here is bullish. And with that, everything else was more or less just confirmation. Overbought condition. We said that the most important bar is going to be this one right here and into the low of this bar. This is where we're going to see that liquidity grab, and we definitely see that. We said that the rally out of it is going to be extremely aggressive. We did that. The extension of that is very favorable, and more importantly, it intrudes into the most important capitulation bar in this whole structure. So it's all like bullish sign, bullish sign, bullish sign, one after another. But I think also another great call here on our part was that we said after this rally, we are going to be in somewhat of a similar overbought condition. And because the trend is so strong, it's going to behave the same way. It's going to have this smaller testing trading ranges hugging the resistance, showing that structural strength, where the sentiment was that we are going to go to 25,000 or even 20,000. And definitely 20 was very unreasonable just based on the sentiment of the conversion from bears to bulls, reluctant conversion right here. And therefore, they are out of the position, and their whole expectation is that the market needs to conform to my ideas that I don't have the position, and I reluctantly switch to the bullish bias, so therefore it should go to 20,000. No, 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 no. That's not how the market works. Market does not hear you, it doesn't care about you. You need to do your own work and your own research. We said in our research that such strength behind the uptrend should produce the analog bars to this, which has followed. And after that, we should have a period of testing. What are we having now? Exactly that. And we said just because of the strength of the market, these two areas are going to be somewhat similar. And that's exactly what's happening. Another clue here for this type of the behavior, because now I'm receiving all of this, like, how did you know? Because I said that, I mean, like I literally just drew it how it, like this, you know, how it should happen. And the question became like, well, how did you know? Well, look at this liquidity graph. This is so aggressive. Demand is still coming in. And it just so much strength. It doesn't really want to even go to the mean. So therefore, it's going to be in the upper part of the trading range, somewhere in the upper part of the upper part, in that overbought kind of like grinding through the resistance type of move, where you don't make a lot of money, but you don't really even have those reactionary lows. We also said that we're going to watch for bar number 4, the breakout bar number 4, because we said that the upward spread should diminish as the buyers are losing that momentum. I mean, like, look how the demand signature is starting to go down. Now, in some cases, let's say like I'm using here a Coinbase, on Binance, the volume signature is going to be like this. Doesn't really matter. The volume spike is there. That's what I'm trying to explain. You know, like you look at the volume and you have to be like, your excuse is that, well, it has to be precise. It doesn't have to be precise. If you can analyze and understand how the price and volume interacts, even the volume spike right here should be sufficient enough for you to understand that there is more buying there and exchange. This is decreasing now, and the upward spread is decreasing. So therefore, we would be expecting a reaction. I'm expecting now that there's going to be some kind of attempt to go up. I should redraw this. And we're probably thinking about the way how this decreased and the way how reaction actually tested. Let me just redo this. So look at this. What is the extent of the test? It's all in the upper part, right? What is the extent of the test? It's like 1/2. What is the extent of the test relative to the significant bar in the upper part? What is the extent of the test? It's to 1/2. So we are seeing deterioration of the demand. Therefore, I would be expecting one last chance, which is happening behind today's bar, to reach this high and maybe to produce some kind of like attempt to go up. So maybe we stop here, maybe we slightly overcome that, but there is a little bit of the deterioration of the demand right here. That would suggest that after this attempt, we probably could have the reaction where to, again, this bar right here. So I would be thinking like this low at the minimum, something like that. Okay, so we'll be following the Bitcoin 356. Oil call was also pretty good. We made 2 calls. One call was made right here on this bar. One call was made right here on this bar. The first call was all about TP distributional formation that we're in one. And we said that we need to have phase C first rally. I clearly remember this sentiment right here where people were saying like, okay, we're going to go to 250 or something like this. And we're already saying we are in the distribution and we are actually going to go to $60. That was the target. We didn't hit $60. Bummer. We hit 64. All right, but we still were in the downtrend. There are quite a lot of interesting discussions here in this downtrend as to the sprints that we had with William and the tape reading. There are quite a lot of those sprint type events and what defines the terminal sprint or what defines the counter trending sprint or what defines the failed sprint. So those are kind of like the ideas out of this analysis. But specifically on this bar right here, we said that we are in the presence of a terminal sprint, meaning that this is the conclusion, at least the temporary conclusion of the downtrend. So terminal sprint behind the bullish background, because we've identified 2 bullish backgrounds here and here. And we said that there is a bullish window where we could have attempts to rally or some kind of rally. And then this test is confirming locally this sprint being so high at the close relative to the low of the sprint and supply going down so much. So we said that not only we're going to have the rally, but for the first time for oil, we're going to break through the mean. This is what we said is going to happen. We're going to break through the mean. It should happen and will happen on the increased volume signature because we are negating the whole idea of an established downtrend since this high right here. So we need more volume, and the catalyst helped out. The announcement by OPEC on the decreased supply of oil. And then we said we're going to have some kind of test, and our idea was maybe we're going to test the mean, cover a little bit of a gap, and then we'll go up again. Much stronger test. Look how horizontal it is. Then the break, for the first time, we're closing the highest in this whole trading range. So still bullish, still positive. Yes, we are reacting right now, but I would say like this is where you are. You're holding the resistance. Our target was not just to come to the downsloping resistance line, but actually overcome it and get into this area right here of 93, which is an important axis line, since this stop in action is an automatic reaction, since this break, since this resistance going back into this area would be logical, that would produce a change of behavior rally, and from there we are kind of retesting the gap, or maybe retesting the whole thing into the lows. But at least temporarily we are done. And this, we said, should be the best rally to the upside. So that's oil. And then the last one, and then we'll go to our exercises, is the 10-year yield. So again, here we were talking about the preconditions for a change of behavior. Here we have confirmed a change of behavior, and we said that we are, I think here on the diminished momentum, we said that the trading range is defined, and more importantly, the bias for this trading range is distributional bias. Not only that, I said that the structure of this is going to be, the structure of this distributional trading range is going to be of TP formation. And here it is. Inability to test the buying climax on both of the rallies. Localized phase C with the local upthrust action, gap. Verticality down, suggesting again presence of supply, extremely aggressive selling. And we said we are going to stop here like we've done before, but we said that this is going to look more bearish, and therefore with that volatility is going to increase, and we're seeing exactly this. So we're still in this localized trading range. I would just do it like this, and I would say that maybe there's going to be some kind of attempts to go up, but we're in the downtrending environment, and my targets for the rates going into the fall of this year is probably going to be around 2.7. So here, think about how the real estate actually is going to go up, mortgages are going to go up as an industry, car loans, you know, people will start using credit again. So this is going to be a welcome relief. Okay, I think that's it for our market update. Again, this is what we do each session, regardless of the class. Now let's go to, okay, yes, a quick announcement. If you like our market updates, definitely come to any of the classes, but specifically Wyckoff Market Discussion class, which is the application of the Wyckoff method. I conduct these sessions together with Bruce Fraser, who has an enormous amount of experience as a Wyckoff trader, analyst, and teacher. And we've been teaching this class together for the last, I believe, 6 years or 7 years. Yeah, actually 7 years. Yeah, so each Wednesday at 3 p.m. Pacific, hour and a half, and you know, we're going through the market analysis, we're going through the stock selection, we sometimes analyze your charts, so check it out and sign up. And if you want an example of this session, you could most definitely check out our YouTube channel. We just had an open door, I think a couple of weeks ago, so check it out. Also from John Colucci, another team member of Wyckoff Associates, of Wyckoff Analytics.com, comes the Wyckoff Market Report. This is a weekly edition of the, as an example of the Wyckoff Report that he publishes. And what's important about this report is that John is a big scan guru on Wyckoff contextual price structure. So he scans based on specific Wyckoff patterns, like a spring, upthrust, backups, breakdowns, and then you could see the health of the market by this, and then also he creates a watch list for you of all of this Wyckoff setups, so you could see how many setups you have each week, and you could judge the market action, but also you could use the Wyckoff, the watch list from the market report, and select your candidate. So it's a weekend edition for you to help out with your selection. All right. Okay, so let's talk about the main issues that we're going to be encountering in our chat analysis. And they are kind of the same as we've discussed them in WTC1. Our first issue is that in our observations of the market participants' behavior on the chart, in a lot of cases, just incorrect. So in all of our classes, and especially fundamental classes, foundational classes like WTC1, WTC2, we teach our students how to observe correctly. And I think that, that lack of observational skills probably tied up also to our mind's inability to hold on and to notice a lot of points of data around us. I mean, like even as I was going to the office and I was going up the stairs, I looked around and there are a lot of trees around, there are some other houses around, and so on and so forth. There's so much information in that picture. So chart always reminds me of life, like what we see in life. Like you look at the street, there are so many data points right there, the colors, the objects, the moving parts of it, and so on and so forth, the sounds. I mean, there is so much that we are given to observe, and yet we lack those observational skills just because of incapacity to retain a lot of data. Then even if we observe this, sometimes we observe the charts in a very non-objective way. And usually it all goes to the past transference where you've experienced something with a very meaningful trade, and I'm sure a lot of you, if not all of you, have that type of experiences where some bad trade was produced and there was some big catalyst event, and I don't mean necessarily fundamental event, but it could be also the chart price related event. Maybe a big bar on a huge volume signature, and you remember that. That's what you remember from that trade. So once that happens again in your trading, unconsciously you go to that moment, and whatever the behaviors were in that moment, they start to repeat because your mind unconsciously remembers that and it starts to protect you. So sometimes observations could be very subjective. We could give the subjective meaning to those. And then obviously we can't observe a lot of data points. So what we are trying to do with our students is through exercises and drills to increase the retention of data points that we could see on the chart. And then obviously deductions. I mean, like in a lot of cases, deductions are built incorrectly just because maybe like there is some kind of flaw in the logic building itself. There is no systematization of the data that's being observed. Sometimes there is an ability to observe a lot, but no ability to systematize that data points. And then the weight of evidence is poorly developed. So all of that, we definitely need to improve. And the practicum is the class for us to do that. So with that, I want to introduce to you exercise number 1 on observations and deductions. And your goal here is to look at the data. I have 7 bars here, so actually 8, but we're going to start with bar number 1 to 7. I have the price bars and I also have the volume bars. I'm going to give you about 30 seconds to think this through and to go through all of the 7 bars and to start making some observations. So we're going to make observations first, and then we're going to make deductions based on those observations. And let's see how well we could do this. So with that, here's your 30 minutes. It starts right now. If you'd like, start writing down those observations in the chat box, and we'll go from there. All right, let's do it. Okay, bar number one. Let's start with bar number one because you're all over the place here, guys. So what does bar number one show us? What kind of observations we could make for bar number one? Okay, Mark is saying indecision. So obviously, like this is probably more about the deductions, right? And decisions is a conclusion to something like where you might be discussing the tails on the upside to the downside, maybe the close and in between, maybe those, hammer, morning star, those type of formations. So, but Mark, I would probably start with just observations first. So what else do you have there? Higher supply. So definitely this is a good observation. So supply has increased on bar number one. And then increase of the supply, decrease of the demand. Okay, so we could see that supply definitely has the capacity, to move the price down from the open and then from the high. The demand also has the capacity to move, but overall, the close to the downside, right? So we had both supply and demand increase on that bar, and yet the result was more expansion to the downside, especially from the previous bar right there. Okay. Supply down. Okay. Dwight, are we talking about bar number one? Right. So we're still there. Okay. Antal is saying increase in volume, increase in spread. Yes. So spread increase. Okay. Large volume signature, yes. So I would add here tails, right? So we see the tails, so we could interpret that in a specific way. And those are the major observations that we could make. So what kind of deductions could we make from that? We definitely seen the presence of the supply. So this could be an observation number one. And basically a presence of selling. So our expectation from here is that we're going to have some kind of reaction. Then we need to make a judgment as to the character of this reaction. Is it a bullish reaction or is it a bearish reaction? Okay, let's go to bar number two. Let's see what kind of reaction do we have. So give me your observations about bar number two. Eric P is asking, is bar number one a commitment? We don't see the commitment yet, right? So our commitment would be below the low of the previous bar. We don't see that commitment. If anything, observation for bar number two is commitment below support. So that's a major one. Okay, large extension to the downside. So the downward spread is expanded. On this expansion, what could we say about the volume signature? I mean, volume is decreasing for sure, but how much is it decreasing? Is it decreasing by a lot, or relative to the last to the first three bars, 1, 2, and 3, is it relatively high? Still, right? So still high volume signature, which is again suggestive of the presence of the supply. And this is more of the deduction, so supply is still present. Okay. And then also, what about the extension into the close or into the low below the support? Is it significant? I would say so. Significant extension below support. And what would we say, what kind of deduction would we have about that? Significant extension below the support. And look at how we are extending here, if we were to take this whole spread, right? So there's only this small part above the support, and then look how much time we spend below the support for that spread. A change of behavior, some of you are saying. Absolutely. This is a change of behavior bar. So after the presence of the supply at 1, we are producing the reaction, and that reaction significantly extends below the support. Bullish or bearish? Definitely bearish. So we are confirming what we found on bar number 1. Okay, let's see if on bar number 3 we could find the same confirmation. Okay, how would we describe bar number 3? What do we see? What do we observe for bar number 3? It's a different bar. It's an up bar. Okay, holding at the support, Eric C is saying. But Eric, what are we trying to do on bar number 3? Are we just trying to hold? What's the intention behind bar number 3? Number 3, increased supply, demand is going down, extend up weak, commit below, demand up, failure to advance. Okay, yeah, the intention behind bar number 3 is to go up and commit above. What do? Do we get to 1/2? Yeah, probably 1/2 of that big change of behavior bar, and then we fail, right? So some supply is coming in. There is a supply increase. So supply increase at 1/2 of the previous significant bar. Attempt to go up, and what? Did we commit even above 1/2 of that big significant bar to the downside? No, right? And we fail, and failure. Okay, and we fail on what kind of volume signature? I mean, when we look at 1, 2, 3, 4, all of them are kind of the same. If anything, 4 and 5 have that decrease in the volume signature, but the first 4 bars are relatively of the same magnitude for the volume. So therefore, we are going to say that volume is high still, and that leads us to the conclusion of what? That supply is still present. So even though this is an up bar, there is an intention to overcome at least 1/2 or the high of bar number 2. We fail on the still relatively high volume signature, which suggests presence of the supply. And because of that presence of the supply, we see that supply tail more than the demand tail. And that suggests that they're selling into an attempt to rally. So there is selling into the rally, attempt to rally. Okay, bar number 4. What do we see there? Volume signature is diminishing significant, selling is diminishing. Therefore, what kind of conclusion would we make here? What kind of deduction? What is to expect when the volume goes down and supply goes down, and that happens in the area of the support? What's the expectation for us there? What should we expect from the price? Another test of the support? How about another attempt to rally? Okay, so we had 2 attempts to rally at 3 and 5. So if our intention was to go up, did we succeed or did we fail? And again, we need to reverse at least 1/2 of that big change of behavior bar. Did we succeed? No, we definitely failed. So failed rally attempt. And now, how do we fail now? Because we failed at 3 as we failed at 5. Did we produce more result to the upside at 5 than at 3 or less? Definitely less. Less upward result at 3 than at 5. So what's our deduction here? Are the rallies or attempts to rally at 3 and 5, are the rally attempts becoming weaker or stronger? Definitely weaker. And if the rally attempts are becoming weaker, then our expectation is going to be for a reversal or a continuation. Definitely continuation. Right? So if we have weaker attempts to rally, we can't expect a reversal, right? So reversal usually will come with at least equal force or better. So therefore, with the weaker rally, Patrick, at 5 than at 3, our expectation not for the reversal, but for the continuation. And continuation happens with bar number 6. What could we say about bar number 6? First of all, what would be the analog to bar number 6? Yeah, bar number 2, correct. So analog to 6 is bar number 2. So with that, what is happening with the downward spread at bar number 6 relative to bar number 2? It's diminishing, right? What about the close at bar number 6 relative to bar number 2? It's definitely diminishing as well, right? So it shows that there is some kind of presence of the demand. Extension also is diminishing, right? So now from this, we go to about this on the close and about this on the low, so shortening of the thrust. So from here, there's shortening of the thrust, there's diminished spread, diminished close, the demand tail itself, and also increase in the volume signature, the spike, is suggestive that there is a presence of the demand. Okay, so a presence of demand should produce what? A suggestion, the presence of the demand is a suggestion for what next price action? A rally, correct. This is our deduction. Okay, with this rally, I'm gonna put here number 7. 7 is our last rally. So with all of this demand coming in and our expectation for the rally, did we have a really good result for the rally? As you say, very poor result, right? So poor upward result behind what? Behind an attempt to rally and close at the support, behind the supply tail, which is still showing the same type of behavior as at 3, at 5. So the price comes to the specific high of importance to us. And in this case to 1/2, in this case to the previous high, in this case to the previous high, and then it's being sold. And the volume signature is still relatively high than, let's say, even at 5. So there is even more supply at 7 than at 5. And with that, this is one of the things that is so hard to grasp for students. You could be in a downtrend and demand could emerge, and it would be suggestive of a rally, but until what happens with the rally? Could we really say that this is absorption? If absorption would happen, what kind of result to the upside would we have? So this whole sequence sometimes could be a problem for students. Like, oh, I see demand coming in the downtrend. I have a short position. I need to close it. Okay, but the presence of the demand is only suggestive of a rally. Do you know what kind of result for the rally you're going to have? No, I don't know, but demand is here. It doesn't really matter. What if it fails to say, like Mark is saying, close above the high of bar number 6? And do we do that? Yes. So if you exit at 6 or on the open at 7, you will be regretting this into the close, and you will most definitely regret this after bar number 7, because this is the downtrend that continues to the downside. There are no changes to the upside here whatsoever, even though you're seeing some demand coming in on a lot of bars. So again, a very interesting way of how sometimes traders, students misinterpret and deduce incorrectly of what needs to, what's going to happen, and based on that, past transference, emotionality from the past. Okay, well, I've seen this before. Demand has come in, and it got me out of the position with the loss. I should have done this much earlier. Well, you don't take into the account that maybe the background was different, maybe the market was behaving differently, maybe you misinterpreted even the, you made incorrect observations at that time. So with that, it's really hard to kind of like argue with the emotional past that we bring into the current chart. But at the same time, during this class, what we're going to do is we're going to reframe your thinking of how you are observing. So we're going to practice more, and then how you're thinking about the bias and where the reversal actually has to come. So the solution to this is obviously more to the downside here, continuation to the downside. Okay, well, this is only 7 bars, maybe 8 bars. And look at how many pieces of information do we have here. I mean, quite a lot, right? So we have, for instance, open, close, high, low, bias. Then we have spread. Within the spread, we have the distance between, let's say, the high and the close, the low and the close. We could have the information here, let's say, between, let's say, the high and the open, and then the low and the open as well. So already there are quite a lot of primary data. Maybe the body of the spread. So this would be the difference between the open and close itself. Then we have, if this is all primary, then we could go into the secondary type of information that we could extract from this chart and all of the bars. And I'm talking only about price at this point. So secondary information, what's the difference between, let's say, close 0 to close 1? Are there any gaps that we're observing? What is the extension above and below the breakout or the breakdown? We could also compare, let's say, bar number 0 spread to bar number 1 spread. We could then go to volume observations, and here just definitely the bias itself is important. What color of the bar we have there. Then any type of differences between, let's say, bar number 0 to bar number 1. Then we also could have ideas about cumulative volume signature for the specific number of bars of the same color, of the same bias, and so on and so forth. So there is quite a lot of pieces of information from the primary, secondary data points that we could extract. And then based on that, we need to do all of those, deductive reasoning. But now imagine that so many pieces of information times the number of bars that we look at. And we didn't even talk about the swing analysis. What if I'm going to give you not 8 bars? What if I'm going to give you a set of bars, data like that? That multiplies the observable data points for us in a very meaningful way. I mean, think about like the whole day. If you have, let's say, if you're an intraday trader and your lowest time frame may be like 1, 3, or 5 minutes, and with that, you kind of have to look through a lot of bars. When you look at the swing trades, you look at the daily chart and you look at the whole structure. When you're a long-term campaigner, you're looking at like major structures with a lot of swings, with a lot of data points. Okay, well, let's try it here now. I'm giving you more data points. How would you interpret this? What is the first impression that you get, by the way? I always ask students, what is your first impression of the chart? And your first impression is usually going to be related again to the ways of how you analyzed the chart before. Okay, so everyone is saying it's a trading range. Well, what about the question of the bias? Okay, Mark is saying overhead resistance with slight upward bias. Ken is saying accumulation. Okay, what else? Anyone sees this as a bearish case? Do we have anybody else on the opposite side? Eric C is saying background is down. Eric, what is it based on? Like you're saying that the background is down. So what gives you that idea? Vitaly is saying it's a distribution. Vitaly, why is this a distribution to you? Volume could be an ease of movement. Okay, accumulation, first 3 bars. Okay. Okay, well, let's go through this. I mean, if anything, I would say from the information that we're given, from this low to the extension to the upside, I would say that the background is probably still to the upside. It's just very limited information here. Okay, so then what do we see on the next reaction, right? So we have 2 bars right here that take us out. Extension is good, right? So we are confirming the upward bias. Then we are reacting. What could we say? What could we observe in this reaction? Let's just call it reaction number 1. Higher low, okay, yes. Change of behavior reaction. Eric is saying, why is that the change of behavior? Well, we definitely coming into the trading range right here, right? So change of behavior leading into a trading range, okay? Fairly volatile, Patrick is saying. Less supply, Mark is saying, okay? Yes, and by the way, I'm gonna give you one hint. This is S&P 500 intraday chart. So therefore, you are going to have the open spike right here, and then naturally the volume signature is going to go down, just in general. But you could use just those kind of like identification. Even though this is a high or low, how much of the rally do we retrace? I mean, probably what, like 80% or so? Not necessarily the best retracement. We want to see maybe much lower retracement. We would want the price to stop somewhere here at the point of the breakout, because this is where they have been buying aggressively to push the price above the resistance, and yet we're going slightly below. So not necessarily liking that we're going that much. Okay, so then the biggest volume spike after that happens on the down bar. We definitely see a lot of aggression of the demand right here. That leads us to this demand tail. What is the result of this aggressive demand as a continuation? What is the result of that demand? Yeah, it's definitely weak, poor result. And that brings a little bit of the suspicion here, because we see a lot of supply coming in, some supply spike right here, and yet the upward result is diminishing. So therefore, there is presence of the supply. Okay, so now that we see the presence of the supply, let's see what it does, right? So once the supply has occurred in this area right here, so here the 3 supply bars, we are producing what out of that? We are producing this and this. How would we characterize, let's say, this bar right here? What can we say about that? Change of behavior bar? Yeah, it could be. I usually would say like this is a change of behavior bar for us right here, but I definitely see the logic here of calling this a change of behavior bar because it's just the largest bar to the downside in this whole structure. So it's kind of interesting how all of the demand that comes in on the last bar is being negated, and we are actually slightly committing below the low of that last upward bar. And look at this, I'm gonna erase this. If here our extension is quite big, here above the resistance extension is quite low, very limited. We can't really hit the same high here ever slightly. So after the emergence of the supply, again, the largest downward spread occurs almost immediately, and it doesn't require a lot of volume signature. So there is this ease of movement that we're seeing on this bar. So again, build the logic around what you're seeing. Supply occurs, we are producing a lower high, which is a failure. And then what happens? And then we are seeing the expansion of the downward spread on significant bar low commitment, right? So below the significant bar low, below this low right here. So still bearish, bearish, bearish. So our logic does not go into the, well, if it looks bearish, I'm looking for any type of reversals, and on any presence of the demand or at the support level, I'm going to be buying. You could most definitely do that if you're a skilled trader, if you could recognize that there could be a counter rally to what seems to be somewhat of a bearish environment or the bearish character. Okay, well, what kind of rally do we have and how could we compare that? Okay, let's compare rally number 3 to rally number 1 and 2. What happens with the upward spread throughout these rallies, especially going into rally number 3? Yeah, it's diminishing. Okay, what happens with the volume signature? Diminishing significantly, right? what happens with the result. I mean, even this marginal observation about where the highs come. So marginally lower high. I know it's a small nuance, but it is so important still to observe and to notice and to make some kind of deduction. Okay, and as we approach the resistance, we have like a small volume spike. So supply here is ever slightly increases, but that is sufficient for what? For this bar to occur. And then we start thinking, okay, we're seeing bar to the downside off the top, bar to the downside off the top, bar to the downside off the top. And now we're seeing how at first we required some kind of meaningful volume presence to do that. And now we don't really need that much of the supply to move the price down. And if anything, we are actually probably what? Somewhat of the same spread. I mean, like the second one is the largest, but still, all of the three look the same. So it takes lesser supply to produce a reversal off the top. That's our main deduction about those bars. Okay, so if we're thinking about analog bars, right? So we're seeing how the rallies are deteriorating. We're seeing how all of the reactions have those big bars off the top. Then we need to see some kind of continuation and whether the bearishness is expanding in its continuation. So I would say, okay, we were looking at this bar, and this bar. What about the bars that follow? So let's say like 1, 2, and then 3. What could we say about those 3 bars? Do we see the expansion of bearishness as we go to the right of the trading range? Or do we see the expansion of bullishness on those down bars? We are comparing bar number 1, which is this is the spread. Number 2, this is the spread. This is the spread right here. We are breaking to the downside. We're going below here. We're going below here. So I would say this is the largest spread. So the downward spread is actually increasing in this case. So now we could create the whole story. Even though the background is to the upside, every time we come to the resistance, we are being sold. And that bearishness is being portrayed to us in all of those 3 down bars. And those 3 down bars shows the ease of movement, meaning that there is less supply that moves and expands the downward result. And that is ultimately bearish. And then we see the confirmation in that secondary bar that actually expands compared to the analog bars of the continuation. Also on the top of that, we're seeing how the rallies from 1 to 2 to 3 deteriorate, whether in the spread or the volume signature or the ability to overcome or touch the resistance. And on the contrary, expansion of the downward spread. So here, if we were to think in terms of the tactics, now that we know the bias, so let's say this is a downward bias, now we could think about the points of entry. Would this be a point of entry? Yeah, this could be a point of entry for us. This is somewhere in the middle of the trading range, so we're thinking more about sign of weakness type of bar as our point of entry. We don't have to be having the stop loss that far away. Usually with this type of bars, sign of weakness or sign of strength bars, we could put the stop loss just above the high of that bar, or just like a logical, intermediate type of stop loss placement. And our expectation is that we're going to break through the support in a major sign of weakness, then attempt to rally. We might like come to this area right here, weak rally, and then continuation to the downside. We probably might have some opportunities here to add a little bit more. So if this is our first tranche right here, we could definitely extend this into a more meaningful position. Okay, let me see, there is a question here. So we're at 446. Okay, from Abi. How do you explain the higher volume from the beginning of the trading range to the end of the trading range? As I said, and Abi, I don't know, let me know if you are an intraday trader. If you're trading S&P 500, your volume signature for the S&P intraday is going to be like this, right? So the first part is going to be the opening, US opening, that is. Then you're going to have lunch, and then you're going to have close. So this is a very typical intraday volume signature, not just for the, let's say, index futures, but also in a lot of cases for stocks. There is a lot of commitment at the end of the session. There is a lot of discounting at the beginning of the session, and there is a period of inactivity during the lunch session. So that's why our expectation is that the volume signature is going to be like this. And then obviously you look for abnormalities during those periods. Okay, so let's just say that we've had our position. So it seems like position would work out. We don't necessarily have the chance to add here just because of this bar. So it intrudes into the body of this breakdown bar a little bit too much. And then when we see this high, we're definitely thinking that demand is present, and we see in this as a confirmation in this volume signature and also in this one right here. So the volume spike is suggestive that demand is present, like it was present on this bar right here. So now it's present on this one, and still even this second down bar still relatively high, so demand is present right there. And then we have the consistency of the presence of the demand on the rally. What is the conclusion? I wonder if you could deduce correctly, what does it mean, this presence of the demand? It could mean a couple of things, but how do you view this? Like, what would be your main deduction there, guys? Because our expectation, remember, was that here we're gonna break and then probably do something like this and then continue to the downside. But then instead of this, we have this, right? Okay, stop in action. Correct, Abi. So this is an intermediate selling climax, at least at this point. This presence, this demand spike is suggestive, stop in action, and then as a lot of you said, going into a trading range. So therefore here we still need to confirm the bias or to negate it, right? So as we go into trading range. So this was a really good call. I would probably manage position here once we have this high as, like, if I'm thinking here, this is too strong because demand is present, so therefore we are in the trading range. This means that the duration is going to increase. So here is our decision-making tree here. So either to hold this position or trim and hold, or exit and then re-enter. So these are the three trading decisions just based on that piece of the information. So if I want to, let's say, trim or exit completely, and I'm already on this bar, this is not a favorable bar to exit. I'm at the break-even point here. So with that, if we are in the trading range, I know how the trading range is going to unfold. From the selling climax, it's going to experience the change of behavior, which is our automatic rally. and then it's going to go into a secondary test at the support. So if that's the case, my secondary test at the support is going to equate either for the point of exit or a trim. And that's it. And you see how logical, when you know how the structure is going to develop, how you could avoid those unnecessary getting out of the position if the price moves against you. You could have an emotional comfort here that after the stop in action, you are going to have some kind of secondary test that's going to come close to the area of the previous stop in action. Just because the stop in action happened and demand came a little bit earlier, I would probably target this low right here than this low right here. And I would say, like, get me out at this price. I would have probably a limit buy order that would equate to the exit or some kind of trim. And that would be my tactic around this area right here. Okay, well, now we are in the new trading range. So what do you guys see here? And let's go a little bit faster because I want us to get to our bias game and discuss that. Question from Patrick: if you see the stop in volume, why wouldn't you consider exiting? That's a good question. Patrick, what if we are expecting that there's going to be a continuation of a downtrend? Would we have any premise to hold on to the current short position? For sure, right? So, as I said, 3 scenarios: hold and add opportunistically, trim and hold, or exit completely and re-enter. Those are the alternatives, Patrick, right? So which one are we choosing here? If you are waiting for a much more meaningful downtrend throughout the whole session, then you might be staying and you might be thinking about adding to the position. If you are, let's say, want to secure some profits right now, just because of how demand has come in, and you know that the duration will increase, you could do the trim and hold. And if you think that your exit, let's say, at the secondary test is going to be better than, let's say, any type of re-entry that you might have, if the price continues to the downside, that is, right? So we need to define what kind of bias we have here. Then that's a possibility as well. Okay, so let's see what you guys are writing here. Okay, Mark is saying more of the same. Eric C is saying decreasing volume in the trading range. Down bars are large spreads. Mark is saying, Dwight is saying bullish. Eric P is saying upswings show strength, high or low. Yes, indeed, we have a series of high lows here. We also had a marginal strength here on the small upthrust, and then we have a marginal strength here on the commitment. So this is the highest commitment. Okay, well, let's do this together. And again, we don't have a lot of time, as I want to go through the bias game before we adjourn. So I'm going to be asking you a series of questions. Just be fast answering those, and we'll get to the actual bias really quickly. Okay, question number 1: what is the background of this for this trading range? Should be very quick. I mean, like, should be almost automatic for you guys. Yes, all of you are saying down. Why? We go below the support, right? We extend down. The character of this reaction is bearish, and this is the most aggressive price action that we're seeing on this chart. So therefore, to the downside. Okay, secondly, where is our break of the previous structure? Where did it happen? I mean, you could make an argument that it happened in 2 places. I would say I would probably go for the breakdown that happens on the two most important breakdown bars right here, right? So we're breaking the local structure here, support, and we're breaking the global structure here as well. So, and this creates for us the origination of this selling, specifically, let's say here on this bar. It creates a selling zone for us. We'll talk about how to create those selling zones later on in the course. So each attempt to go through this selling zone concludes with what? What comes after an attempt to commit to that zone or overcome this zone? Any type of approaches. More selling, failure than reaction, yeah, drop. Correct. And do you see how simple it could be in terms of the analysis if you know what to look exactly for? All right, so we're looking, the background is to the downside. There is definitely some selling coming in, and it cannot overcome this level anytime that it does. And then on the last attempt to do so, what do we see? We are trying to overcome the resistance on this bar, commitment, marginal commitment, not even commitment above this high, just the highest close here, but not over the resistance. And then on the next day, what happens here? What's the observation that we could make after some emergence of the supply? Volume stays relatively high, and then are we negating all of the gains? Yeah, we're negating the gains for this day. If this was a sign of strength, then we need to have progression to the upside. We don't have that. Instead, we have immediate negation of that last commitment to the upside. Bullish or bearish? Bearish. And that's on the background to the downside. And I would say just in general also observations, like volatility is still pretty high here. If we look at all of the rallies and the reactions, it takes 1, 2, 3, 4, 5 days to go up, 2 days to go down, 3 days to go up, 1 day to go down. 1, 2, 3, 3 days to go up, 2 days to go down. And then every time we have an up day, the down day comes almost immediately. Bullish or bearish character? Definitely bearish. Again, background is extremely important. So continuation. So this would be another point of entry for us. Again, this would be either point of entry, this would be an add-on, or re-entry. Whatever situation we are in, did we have the position before, we are re-entering. If we do have the position, we could add to the position. If we didn't have the position, we could enter this position. And our expectation is kind of the same, is that we're going to break the structure. Now we're going to be looking for some kind of extension. What's going to happen here? What kind of character of the move to the downside we could possibly have here? What kind of volume spikes we're going to have at the next potential stop in action compared to what? Compared to this, right? So we're already preparing to what the price could potentially do. Okay, so as we go through this structure and through this breakdown, we're looking at this, and look how this extends, right? So this is a much better breakdown than we have had before. Although cumulatively, that could be a possibility here that the volume signature here of these two bars could exceed, and this exceeds. It's probably would come up to here. But at the same time, if we would say that the cumulative volume here on the breakdown bars, so we're looking at this two, comparing it to this one. Here I'm thinking with slightly less volume, we have a better extension. So this means better continuation to the downside than what we've had. And we definitely seen that better continuation to the downside. So we could hold on a little bit longer here. And we're just doing this based on judging the market by its own action. That's what we're doing right here. Last point of supply, another point, potential point of entry, the volume signature is still pretty high, so some supply is there, and then immediate negation, so you're thinking that this is what we're going to do. Here, continue to the downside. Momentum is decreasing, but look at the behind the momentum decrease, we're looking for the volume spikes to identify favorable points of entry for us. Because here we know that we're going to have some kind of rally. Usually that rally after the decrease of the momentum would come into the lows of that first aggression move, and we're seeing how we come exactly there. And then as we go down now, we should be comparing reaction number 1 to reaction number 2 to reaction number 3. Or we could compare trade instruction number 1 to 2 to 3. Okay, I'm going to give you maybe 20, 30 seconds. Think about what should happen next with the structure. What kind of bias should we have? And base it on this 2 comparisons. Comparisons of the reactions, and then also comparisons of the trading ranges. And write it down. All right, let's see your answers. Okay, sideways, volume is shrinking into the third trading range, spread down, decreasing in the third swing. Reaction number 3 is the weakest reaction, meaning bullish, more bearish, less supply, perhaps absorption is happening, a rally coming maybe. Number 3 range, the candles are unable to rally to the high of the significant down bar. Okay, interesting. Yes. So there are 2 observations that we could make here. Number 1, let's just say observation that is done based on what could we take first? Okay, let's talk about the reactions first. Okay, so what do we see with the reactions? We are seeing how the downward spread is diminishing on those reactions. We are seeing how the volume spike or spikes also diminishing, right, on those stopping actions, or some random bars, random supply bars in the trading range. So supply is diminishing, and we're seeing just the overall decline in volatility, right? So with all of this, we're probably deducing that we are going from bearish to bullish environment. which in this case is our trading range. Okay, so we looked at the reactions. Reactions gave us the bias. And now we're looking at the trading range. So looking at the trading ranges, again, we're seeing how volatility has decreased significantly. That suggests bullish behavior. But I think there's, comment by Abi, I think, that the number 3 range, the candles, the number 3 trading range, within that trading range, the candles, the up candles, are unable to rally to the high of the significant down bar. So for instance, we were talking about the breakdown bars. Those are important bars, like right here, or this too, right? Okay, so what do we see here? In the first case, we're seeing how the rally expands to the upside, and the expansion happens in the second part. It means that the buyers are coming as the rally starts to develop. Here we're seeing a completely different picture. Here we're seeing buying off the bottom, and then momentum starts to diminish. So here we're coming in into the low of the breakdown bar. Here we come in into maybe like 1/2. What does it mean? Right? It means that demand is weaker, demand in the trading range. Number 3, on the change of behavior rally, is weaker than demand in trading range number 2. But what does this mean? This is just a conclusion out of the observations. But what is the deduction here? So Antal is saying it's weaker, right? I'm assuming, Antal, you're talking about the trading range number 3, right? Okay, so therefore, weaker trading range. If this is a weaker trading range, but we said it's actually in a bullish environment, how could the trading range be weaker in the bullish environment? How would that materialize into what? I mean, like, it has to come out into something. It has to become some kind of quality, right? So a weaker bullish trading range, how would that look like? If the volatility is decreasing. If volatility is decreasing, could we have a lower low in this trading range? Let me put this logic here. If volatility is decreasing, could we have a lower low or a higher low? What's the probability there? Probably a higher low, right? Okay. So then how could we depict how to depict weaker trading range in bullish environment with expectations for a higher low? How would the structure look like that? Michael, what is this? A preliminary support in the, what is this, DT? A downtrend. Okay, yes. It could be a possibility, but we're saying, Michael, that the volatility on reaction number 3 is so low, we're probably not going to have a continuation here. We're probably going to have either a rally or attempt to rally. But again, we said that the change of behavior is weaker than, let's say, this change of behavior. Okay, I'm going to give you a clue here. Well, not actually the clue. I'm just going to give you an answer here. We are in a bullish trading range at this point. We are in an attempt to rally just based on the decrease of volatility on reaction number 3. But because the change of behavior of this trading range started somewhat weaker then instead of kind of like rallying right away, we're probably going to have attempts to rally with some slight overcoming into the upthrust action type of things, right? And then after that, the duration should increase. So bullish environment, but the weaker demand would produce the extension of the trading range with multiple attempts to break out that are going to fail. And then into the end of it, it is a possibility that after the higher lows environment, we could have maybe like a lower low, maybe like a localized lower low to the previous low, or maybe to the global low stop in action. We would have to kind of like see what happens here. So that's our judgment of the market by its own action. So let's see what happens. So here we're seeing that this tentative demand is producing the increase of the duration for the trading range. That number one, attempts to overcome with upthrusts and so on and so forth. And at this point, we have to make a decision. What are we doing here? Could the price finally go up from here, or will it continue going to the downside? Okay, so what do you guys think? And let's do this as a flashcard. Dear, okay, up, 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 up. Okay, continues trading up. Last point of support. Okay. Okay. All right. So majority of you are saying up. How's the demand? I mean, like, what is the strength of the demand? So we said here it was weak. How is it, let's say, on the next rally, if you would compare 1 to 2? Is demand better on rally number 2? Okay, so we would look at the presence of the demand, right? Compare it. That's number one. Then we would look at the spread, right? In terms of how the character unfolds. So we have this spread, this spread, this spread, this spread, this spread. Okay, well, maybe somewhat the same, maybe slightly less, maybe slightly more, somewhat of the equal, somewhat close to each other, similar. Okay, what about the upward result here? Have we committed above the resistance? No, right? So we have less demand, less result. So definitely we are coming from a weaker to more weaker. Okay, so then the next rally, rally number 3, spread, spread, spread. But I would say like here, the most important bar is this. This is the volume aberration for us, right? So like we've had here, and we are going up. We have some supply, and that comes in where? On the breakdown bar. So the breakdown bar acts as the supply zone for us. And finally, when supply comes, what does the price do? Does it go up? Or there are attempts to go up and then there is a failure? Definitely failure. This failure would be confirmed if the price would continue going down here. And now the question here is, are we in the accumulation formation or are we in the redistributional formation? If this is an accumulation formation, then we could have a spring, we could have a shakeout, we could have last point of support. If we're in the redistributional formation, we should have a sign of weakness. And all of this could look completely differently. All right, so with that, our expectation is that this supply in the selling zone should bring us at least to retest some kind of like this target zone. if especially it breaks this level. Okay, and this is what we have. Okay, so this would be a really good point of entry. Again, our target is all of this. So this is a local support in phase B that we need to break for the sprint position. This is a global support. We're seeing that increase in the volume signature, localized increase of the supply, and a global decrease of the supply. Is this a sprint? And then what happens with the rally? I'm seeing upward spread is diminishing, and I'm seeing that the volume signature is also very low. Okay, so give me your analysis here for this trading range. Up or down from here? Upward bias or downward bias? And especially, I want you to think about the last rally. What are we seeing here? Volume is going down, upward spread is going down. Okay, some of you saying sign of weakness, up, weak, still bearish. Okay, so we're gonna address this first with this spring. So this is definitely a sprint type event. We're seeing the diminished spread, right? So for instance, observe this spread, number 1, number 2, number 3, number 4, 5, 6, 7. Okay, so let's follow the logic here. Number 1 is increasing the spread, coming to the support, cannot break it. Number 2, actually breaking the support, committing down, increasing the spread, more bearish. Expectation is to the downside. Number 3, the actual breakdown bar, which is comparable to this and to this area right here and somewhere here. So these are our analog areas right there. Then what do we see after bar number 3? Number 4, diminishing spread, same volume signature, presence of the demand. Number 5, limited commitment to the downside, if none at all, and the highest volume signature, more demand. Number 6, attempt to commit down only intraday penetration below the low of the previous bar. The volume signature is still pretty high, more demand. So there is an accumulation of the demand of buying as the price goes down. Number 7 acts as the test because the volume signature goes down by maybe like 45%. So 45% less selling on the higher low, which is the test. Therefore, expectation for the rally. So, okay, so we are seeing that demand is present. What could this demand produce? We are seeing diminishing upward spread, diminishing volume signature. So a lot of you said that the character of it is what we would say looks bearish, right? And this is a very common look for the rally like this with the lower spread, low volume signature. It's kind of like this laborious move to the upside. But at the same time, the most important question for us, what is the upward result? Because it could, as I coined this phrase, looks bearish acts bullish, or looks bullish acts bearish. As we're looking at the character, it means nothing for the result. So what is the upward result doing? Is the upward result increasing on the last rally or decreasing? So how would we measure the result, right? So we would look at the extension of all of the rallies, and we would say, what is the largest rally? the upward result is definitely increasing in terms of the distance, right? So the distance of upswing has increased. We have not overcome the resistance yet, but we could also note that on the way up, there are a lot of reactions here that we are observing in the rallies, right? We don't actually have big reactions here. So that's another sign of bullishness. We also have a lot of consistency of the demand, meaning that as they buy almost each day, which is also more of the institutional behavior. So I would say the upward result is increasing, but it looks as if demand is so weak. And what kind of supply do we have? Here and here, this is nothing. This is the lowest volume signature for the supply. So definitely bullish. And from this whole picture then, as we went through this, we're seeing that there was a stop in action. Demand was present here, but demand was not that strong, and therefore a weaker change of behavior rally suggested the trading range duration increase. Yet this reaction suggested a decrease of volatility and therefore a bullish environment and bullish bias for this formation. So here we are saying like we are in the potentially bullish formation, but we are going to be in the trading range for a while. We could have some kind of upthrusts, but ultimately, as the demand is not so strong, we're probably going to have some kind of event into potential phase C. And out of that potential phase C, we see demand emerging, demand consistency, and then the upward result is improving. So therefore, somewhere here, we could start getting busy with our orders. So for instance, here would be a really good point of entry behind the very favorable testing. Or even here, if we're thinking like, okay, we might be overcoming this and maybe here's our target. Even here, we could start initiating the position, because if the declines are so weak here, we might actually see some kind of acceleration to the previous high very, very quickly. If supply is so weak, we might not stay here for a while. The backing up action here could be very, very quick and shallow. So let's look what happens. Instantly, we are breaking on abnormal volume signature, and this is the best demand signature as the upward result expands. So therefore, a good breakout and then continuation to the upside to our target. So here we would be just following the significant bars and the stop losses, and our exit could be here. But based on the momentum, you could hold through the first reaction and exit into the close. And that's the whole trade. And that's the whole day. So you kind of could see how, and we're taking just one intraday chart here for the S&P 500, how through observations and deductions, you could follow the flow of the supply and demand, and you could see where there are changes of behavior between supply and demand. And this is where you want to take your positions. And obviously, based on that change, you also manage your trades as well. Okay, now for those of you who are more advanced and you guys feel like, okay, I can handle this. This is not necessarily what I recommend to our beginners and intermediate students right away, but after the WTC2, I usually would suggest go to the Wyckoff Tape Trading Lab, which we conduct usually on Mondays. Now they are going to be on Wednesdays, so tomorrow you could check it out. And together with William, we go through the market, then we do some, practice drills, and it's all about chart reading and tape reading, or tape reading that we see on the chart. So I would absolutely highly suggest this, only with one caveat, and that is you have to be extremely comfortable with the material that I gave you right now. Okay, let's talk about the bias game. So the bias game has become kind of a big deal for our company. This is one of the educational tools that we use. And each week we present to the world one bias game. It takes a lot of time, to go through the process of the creation. There are quite a few people who are involved because we are trying to elevate this to a very high professional level. For our students, what I would suggest, first of all, keep the score of your bias games. Keep the score for this semester. Keep the score of any bias games on our website or on our Twitter that you're doing, because you would want to do quite a lot of things there. And again, next class, we're going to discuss what exactly I want you to do with the bias game, what kind of stats I want you to keep, what kind of analysis I want you to do, and so on and so forth. Here's our last bias game, number 187. And this is an action sequence bias games for the last 4 or 5 games. We are clearly here in the uptrend, and then we have 1, 2, and 3 rallies, and we come into a stop in action. So 3 cases for us here to compare. So with that, for those of you who have not seen this game, please think about this, analyze this, give me your bias. For those of you who are students and you have done this work already in anticipation for this week's bias game, let me know how you solved it. And obviously a regular question for me here to you is just based on your work and compare that to the solution that you could find on Twitter already, what was the biggest challenge with this bias game? So give me your bias, give me your solution here, and then what was your biggest challenge? Okay, so not a lot of people have done this bias game, so we kind of relaxed a little bit. Okay. So Eric, what was the biggest challenge here? And of the climactic run, suggestion for the trading range or the reaction? Yeah, okay, well, let's just go through this. First of all, we are in the uptrend right away. We need to identify the background. Okay, so it's an uptrend. Then we said that in the first 2 cases, the way how we stop with the buying climax, then we go into some kind of change of behavior. Look at how the last significant bar, and I'm trying to solve this as a potential flashcard. We'll talk about flashcard bias analysis later on in the course here. But look at how these bars, which are significant bars, are holding the ground, right? So there is no violation, whether this is the commitment to the downside or even intraday violation for these significant bars. Maybe right here, there's some intraday, but the closes are still higher. Okay, so this is a regular behavior in this uptrend. So now let's go to rally number 3 and let's look how it ends. First of all, we should notice that there is most definitely a slightly different climactic run into the buying climax at point number 3. It looks more climactic. It looks more exhaustive, right? So look at the volume signature that we have on the approach. What do you see? I see that maybe cumulatively, this is the highest volume signature, highest cumulative volume signature. So therefore, if this is the highest, then there is definitely some presence of the supply. And we are also seeing in the climactic run, this is more of the climactic, like a more aggressive climactic run and a more aggressive extension. Why? there are more market participants at this point. If there are more market participants, then CO would be inclined to do what? Sell into liquidity. Okay, well, would we have a confirmation of that sell-in? We do have the confirmation of that sell-in just in the up bars themselves. But then also the next down bar, let's say even compared to the analogs, are somewhat big. It is bigger by about what? Maybe like plus 30% more sell-in. So we have more sell-in on the climactic bars themselves, and then we have the sell-in on the first down bar. And if we were to compare, let's say, all of the first down bars, right? So let me just clean this. Okay, let's say this bar to this bar to this bar to this bar. What could we say? Let's say in terms of the volume signature, this, and this. And we said that supply is definitely increasing, sell-in is increasing. We said this to this and then to this. Definitely supply is increasing as they sell on the way up. And then we said that all of these significant bars, they do not have any commitments to the downside. Okay, so here is our last significant bar to the upside. It is sufficient to identify this as like one bar to the upside, like this one right here, or like this one right here. This is the same. And what do we see? The low of it, and then we see the commitment down. And that commitment extends somewhat. Not a lot, but still extends. The next bar is the rally, is an attempt to rally and still supply is present. And then after that, another attempt to rally and demand is going down significantly. And that's it, that's all sure out. All of these observations should tell you that supply is heavily present in this 4 bars that we see. And for the first time, there is a commitment to the downside after the opening gap. And this is not what we've seen before in any of the situations. So here's your flashcard idea. And that's it. Yeah, Eric C is saying, I took the 2 bars together as an extension to the upside. I think it's totally fine, Eric. I mean, like, I definitely would probably still think that, you know, I would love to see, you know, some kind of commitment. Like, where did we have 2 bars before as a combo? I mean, this is like a huge type of bar, right? So for instance, here, we've seen 2 bars as a combo. So what do we see? We're seeing here how maybe like the first bar has been violated the low of the true range, right? So this is the true range. It's been violated, but the close was still higher. Here we're seeing this is a violation, but the close is lower. So even if you're using 2, you still could see the difference there. But if you're using 1, the last one, then most definitely you see like this is a true commitment. There is no commitment here. There is no commitment, let's say, here or here. And there is definitely no commitment here to the downside. So this is absolutely different in terms of the approach, the commitment down, and the presence of the supply. And from here, I want to come back to the idea that, who got it? Eric P. Eric P said, climactic run, buying climax, this should lead to a trading range, which starts with the change of behavior rally, which is an automatic reaction. So the only question here becomes where to? What's the target for that change of behavior? And we could trade that for sure. I mean, like we could, if we're short-term traders, any type of break here would be our stop sell order with an idea that we only trade in the change of behavior reaction into the low. So obviously here we have a couple of levels and we would be thinking, okay, probably somewhere here, this could be our target, initial target. And here is our swing trade. Okay, well, let's see what happens. Here we are. We're seeing continuation right away. The rallies again are pretty weak here, and then the gap. This suggests aggression, and look at the supply. It's just confirming that the change of behavior is taking place. Not only that, I mean, like we've come to the target, but we actually go even lower. So this negation right here is kind of like very suggestive of at least a trading range, but definitely has a little bit of a bearish connotation here for the trading range that is unfolding. And that we still have to see and we still have to analyze as the trading range develops. So what I would suggest, guys, is again, when you work with the bias game, first, go to the assignment slide, solve this, then come to the solution slide by us and check our solution against yours. And we'll talk more about specific post-analysis techniques that I want you to know as we, go forward with our semester. And I'm going to teach you that. So there's going to be a lot of work. And with that, here's the continuation of this chart. And here is your next bias game number 188. So I'm asking you a question here. What do you see here? What's the bias? And then next week, after you're done with this homework, and you have two homeworks, you have a bias game number 188 as the homework, and also you have two articles to read. So let's discuss the articles, let's discuss the solution to this bias game, and then also let's discuss the anatomy of the trade next time. And I'm gonna give you finally the sequential bias analysis, the way how we are analyzing the trading ranges. Okay, so with that, here is your homework. So bias game number 188. And this is it for today, guys. That's it. We've done it. All right. For those of you who managed to go through the whole class, thank you so much for being here. For those of you who are guests, or maybe you're listening our class on YouTube channel. So if you consider join us, you have to start with WTC1. So do that and then join us here for this class. And hopefully this is enough of an interest to you to sign up for this course or to sign up for WTC1 or any other products that we have. Check out our free offerings also, both on websites and YouTube channel and on Twitter. We have quite a few free things as well, like a bias game, like a lot of articles, some suggestions for books, lots of videos on our YouTube channel, market updates on a daily basis on Twitter, and newsletter, weekly newsletter to update you what's going on in our community. All right, guys, with this, thank you so much. Eric P is saying thank you, great as usual, and Eric C is saying exhausting but excellent. And this is where we're going to be. This is the mental space that we're going to be for the whole semester. We're going to exhaust ourselves with so much practice that when you're done with this semester, you're going to be in that constant process of creating a habitual behavior to be to develop your visual recognition and execution skills. With that, thank you guys so much. If you have any questions about the signups, let us know. Email us at wyckofassociates@gmail.com. I will see you all next Tuesday at the same 3 p.m. Pacific, and we'll continue our work. With that, thank you so much. Happy trading. Until then, bye-bye.